Hello everyone, this is Rahul Jakaria from Sharekhan. Welcome back to exciting 3R actionable stock updates. 3R basically means right sector, right quality and right valuation. These are our investment ideas. Today we have an update on Gateway Distriparks. Our analyst retains buy on Gateway Distriparks with a revised price target of ₹90, increasing the valuation multiple considering improving export-import growth outlook. For Q1, GDL reported largely inline operational performance, while a lower effective tax rate led to a PAT beat. The CFS business remained weak as per the expectation. For FY24, the management expects 10 to 15% year-on-year volume growth in rail, led by improving export-import balance. It plans to add 3 new rakes in the balance fiscal year and target to add 3 rakes per annum. The company will incur ₹300 crore of capex over FY24-FY25 on 2 new terminals, upgradation of existing terminals, Jaipur ICD, replacement in the vehicle fleet and leasing 3 rakes. Next on radar is Cholafinance. Our analyst maintains buy rating on Cholafinance with a price target of ₹1350. Company reported weak performance despite strong growth in Q1, led by NIM's compression and higher credit cost. We believe the near-term outlook remains positive except for the cost of funds. It is likely to sustain rich valuation on account of higher growth potential and steady return ratios. The company is likely to deliver a consistently sustainable ROE of 18 to 20%, strong AUM growth, bottoming out of margins in the coming quarters, moderation in OPEX growth and lower credit costs should translate into a healthy earnings trajectory going ahead. The new business segment is still in a nascent stage, with asset quality performance untested. However, we take some comfort from the company's historic execution track record. In the past business cycle, the company has performed well, which provide comforts in the quality of its high growth. An equity fundraising in FY24 is an additional catalyst. The stock has outperformed the broader indices in last 1 year, and it currently trades at 4.5 times FY24 adjusted book value and FY25 4.1 times adjusted book value estimates. Last we covered Kirloskar Brothers. Our analyst reiterates positive view on Kirloskar Brothers as Q1 was marked by a sharp improvement in operating profit margins. Sales grew by 15% year-on-year, while operating profit margin and adjusted net profit growth was a 170% and 277% respectively on year-on-year basis. The performance was driven by overseas business, stable demand in domestic market, increasing share of energy efficient pumps and value-added services. Company sees opportunity in irrigation, solar, nuclear power, oil and gas and other emerging sectors. The management expects demand momentum to continue in both B2B and B2C segments and expect margin trajectory to get stronger in both domestic and international business. The consistently good show since past few quarters warrant earnings upgrade and would lead to price to equity expansion for the stock. Currently it trades at 22 times FY24 estimated EPS and 18.5 times FY25 estimated EPS. For more detailed disclosures and disclaimers, please refer to our research report or contact our nearest branch. Please read the risk disclosure document issued by SEBI and relevant exchanges and terms and conditions on sharekhan.com before investing.
Thank you for watching. To keep up with the latest from Sharekhan, make sure you subscribe to our channel. You can also download the Sharekhan app for all your trading and investing needs. Investment in securities market are subject to market risks. Read all the related documents carefully before investing.